Do you all remember the 2008 energy crisis? Was it a bit too much for the auto industry? It took a good 5 years for the industry to recover from the worst recession. What if we told you that something much more terrific than the 2008 recession will happen soon? If you want to find out more, tag along with us till the end. Welcome to yet another informative video about the upcoming recession. Before we begin, don't forget to subscribe to the channel and turn on the post notification, as it will help you get the latest updated information about the upcoming recession and wise decisions. Without further ado, let's begin. The $2.8 trillion automotive industry fell apart in the blink of an eye. The overnight crash took the entire world by storm, and the rest is history. Within a few months, hundreds of billions of dollars were destroyed drastically. Being the hardest-hit sector due to the recession, the automakers found it extremely hard even to survive. As the sales fell by about 40%, the employment opportunities also reduced. Many were even laid off. The GM Motors and Chrysler were almost having a good time before all this. However, they were pushed to bankruptcy in no time, so they were bailed out by the government. Did you know that about 61% of General Motors was owned by the federal government at one point? It wasn't just GM and Chrysler who had their worst dream come true. Toyota faced the first loss in its 70 years of experience. What's much worse than this is we will have to face something more drastic than this soon. That's what Cathie Wood, the CEO of ARK Invest, has to say. In the financial sector, the University of Michigan Consumer Sentiment Survey holds great value. A question that they have put for the survey since 1961 is, do you think the next 12 months or so will be a good time or a bad time to buy a new vehicle, such as a car, van, or sport utility vehicle? What's shocking is that the consumer sentiment has only become negative over time. The majority think it's a bad time to purchase a vehicle in the current situation. However, automakers wouldn't accept that the current situation isn't ideal. They would always say that the demand is always high, so they will claim that the prices will shoot up due to demand. On the contrary, such price hikes are felt not due to demand. It is due to a lack of supply. Usage of semiconductors will be in addition to the industry. The demand will likely be at an all-time low while the chips arrive. If we are comparing the car prices last year, we can infer that the prices have increased by $11,000 on average. In a nutshell, we can say that the increased prices will only make the industry less affordable. Doesn't it sound more like a bubble? The demand and prices are apparently disproportional. This will eventually leave the automakers in a situation that is characterized by oversupply. Basically a glut. An added concern is the shortage of semiconductors. The sales are rebounding due to the shortage. Once this shortage issue dissipates, the demand might be restored somewhat. At the same time, urgent demand issues will kick in. According to Cathie Wood, all these issues are adding on to inflict a great disaster. This isn't just the problem reserved for the automobile sector. The entire global market is going to experience something drastic shortly. Supply and demand should drive the prices of new cars and used cars. Cathie Wood is an investment whiz and disruption guru. She thinks that even used car prices will plummet. She even remarked, "It is going to be a bloodbath. Let's hope it's less likely to happen." Of course, if that's the case, then it would be great for Wood as well. Because the plummeting of prices wouldn't be good for Wood. Because of the largest holding in ARK, Tesla will also get affected if things go as per her predictions. What she thinks is that the used car valuations might as well plunge this year and the next year. Due to the pandemic, the value surged and it resulted in fewer inventories. Certainly, if you look at the used car prices, you will know it's high. Let's now take a look at the index. At present, the Manheim U.S. Used Vehicle Index is at 236.2. It's a new record. It is about 88% up from the pandemic-inflicted low, which was 125.8. This is April 2020's statistics. An investor can easily understand the whole trend by just comparing the numbers. And possibly you will worry about a potential drop. Fret not. If a drop like Cathie Wood predicted happens, then it wouldn't be exactly a bloodbath. One thing we can't overlook is that an index isn't as volatile as a stock. It's not even as volatile as Wood's ARK Innovation ETF. The highest dip in the index happened unsurprisingly during April 2020. It was about 12%. If the index was at 143.5 in February, then it dipped and hit 125.8 in April 2020. One thing that wouldn't show a dramatic dip is the vehicle inventory levels. Those levels drop relatively slowly, giving us a hint about the trend. What we can say as a whole is that the supply is low. It is experienced by almost all automakers. However, on the contrary, the demand is low for all cars. If you are someone who is contemplating purchasing new or used cars, then you will be shocked when checking out the prices. Why are we talking about both new and used car prices at the same time? It's because both are connected. A shift or dramatic change in one thing will directly affect the other. While we all are focusing on new car sales, the truth is that the sector is almost 2 to 3 times less in size than the used car market. In a report that the benchmark auto analyst Mike Ward made, it was stated that the new car inventory total to 25 days of supply, when compared to the historical average of 58 days. What we can infer as a whole is that the slowed production was inflicted due to the global chip shortage and slowed vehicle production due to inventory issues. Don't you think that 2021 was a perfect storm? The massive financial stimulation greatly catalyzed the initial crash of new vehicle availability. This is what the Cox Automotive data provider stated. Cox Automotive, which is the parent company of Manheim, and the Kelley Blue Book, is regarded as the popular used car valuation reference. Meanwhile, the used vehicle values ended last year well. The experts think it doesn't mean the crash won't happen. It just means a crash is pending. However, the depth won't be that much. The market fundamentals don't support such a scenario. Cox also added that the ratio of new car values to used car values seems to be out of whack with history. So low inventories aren't the only thing. As we mentioned earlier, the used car prices are high. At the same time, new car prices are at record levels too. Used car prices can't just tumble without more inventory or reasonable new cars. Of course, car demand drives it all. A demand-induced spill would take a lot. Tesla is its lead. In the current scenario, electric vehicles will lead the way. The usage of gas-powered cars will be out of the question soon. Gas-powered ones will lose their value soon, and we know where the industry is headed. It appears like a trend for another decade. It's also possible the remaining value for gas cars will fall as EV will become dominant. Like, who would prefer older technology when one wants to stay updated? In the near future, it would become easier to charge an EV than fill a car with gas. In the U.S., about 3 to 4% of new car sales are contributed by EV. A small fraction of such cars are available to buy and sell in America. Also, at the moment there are over 275 million vehicles registered in the country. Some experts think that the EV impact will take time to penetrate. The time to unfold gas car values will happen slowly, maybe as equal the time to rebuild vehicle inventories. Wood said in a recent CNBC interview that it appears as if we are in a recession. Cathie Wood says, "We think a big problem out there is inventories, the increase of which I've never seen this large in my career. I've been around for 4 to 5 years. I think the inflows are happening because our clients have been diversifying away from broad-based benchmarks like the NASDAQ 100. We are dedicated completely to disruptive innovation. Innovation solves problems. The near future condition will be revealed over time. It's just a matter of time. Please note that nothing mentioned in this video should be seen as financial advice. With that, we have come to the end of the video. Goodbye.